Tom Lee, one of the biggest bulls in this market, just came on CNBC and issued a critical warning for all investors for the next 8 weeks. But it comes with a twist. And since you know in my videos, I don't hold you hostage, the bottom line always comes first. If you got stuff to do, if you got places to be, I don't have to hold you hostage until the end of the video just to let you know what Tom Lee said. So the structure of the video is very simple. Bottom line first, then we do the analysis. If you want to stick around, great. If you can't, also no problemo. So bottom line, don't click nothing, don't smash nothing, don't buy nothing. Check this out. Tom Lee basically said one simple thing. Guys, I believe we're going to drop 7 to 10% on the S&P 500 sometime in the next 8 weeks. But it's going to be a dip of a temporary nature. It's not going to be something that indicates a market weakness. In fact, it's going to be a massive buying opportunity because we haven't seen the peaks of 2024. It's a very strong market, and this is going to be a temporary dip, and it's going to be a massive opportunity for smart investors to load up on cheaper stock.
I think investors should be cautious for the next 8 weeks. Market's been up 7 of the 8 months this year, so we know it's an incredibly strong market, but we also have the September cuts and we have the election, things that'll get people nervous. I think in the next 8 weeks, people get a chance to buy. So I think it's good to be cautious, but just ready to buy that dip. Good.
How far down, Tom? 10%?
I think that 7 to 10 is a possibility. And we've already had 2 7% corrections this year. You know, I think we should expect turbulence. I would just say at the bottom line is it's a strong market, so I don't think we've seen the top for 2024. It's just that the next 8 weeks are tougher.
So Tom Lee starts this clip with this statement. Hey, 7 to 10% dip in September and October. But it's going to be due to nervousness, due to volatility from macroeconomic data that's going to be maybe shaky or confusing, due to elections. There's going to be a lot of chaos, a lot of mess, and all of this nervousness is going to break out. And this market that's been going very, very strong, 7 out of the past 8 months have been positive, is due for a correction. Now, obviously, that 7 out of 8 months is also an indication of a very strong market fundamentally, but it is also kind of a double-edged sword because it is due for correction. Now, the second point he makes is very important. He says, look, guys, this nervousness, this shakiness, all this anxiousness is going to create massive opportunities. Smart investors are going to load up at discounts, and they will drop their prices on the existing stocks they have or set up new positions, all through these headless chickens running around thinking that a 7 to 10% dip in the S&P 500 is literally the end of the world, which obviously it isn't because the market is very strong. And it's kind of funny because in one of my previous videos, I've told you the same thing, literally the same. I told you, hey, one more big sell-off event is coming. It's going to shake out the weak hands, and all the pros are going to buy up, scoop it up before the big elevator goes up. I'm saying here is that the market in its current configuration is a little bit overextended and is due for a correction. The market goes up, it goes down. It does not go up in a straight line for 4 years. You're always going to have corrections. And if you're seeing one coming a mile away, just sit there and ignore it and say, la, 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 this is not happening. It's not a good strategy for a long-term investor. Having said that, I see a correction in order for this market. I've told you this, and now Tom Lee is basically agreeing with me, so I guess great minds, you know. Now I'm not saying Tom Lee copied my idea, but I'm kind of seeing that it's obvious from this market, and Tom Lee is looking at the same setup. He's basically saying the same thing. Look, this is a setup right now that's built from one more shake-off event, and then it's going to go up, and a lot of people will miss out because they're going to be panicking, they're going to be fearful, they're going to be running around like headless chickens without any plan, any sort of idea what to do. And I'll talk about it in a second. Media is really good at creating this panic. They get clicks of it, they get ad money from it, but they're also kind of in cahoots with all the professionals that want to drive you out the market before the big spike up. Don't forget it. It's important to understand that if that dip happens, we'll talk about what happens if it doesn't, but if that dip that Tom Lee is talking about happens, what should you do? Well, number one, you should be prepared, because prepping money in the last second is not going to be very effective. You have to have the cash ready now. Be prepared with cash on the sideline before it happens. Running around scrambling once prices drop looking for cash to buy up stocks is not a good idea. So whatever happens, make sure you have that thing on the sideline prepped to go should Tom Lee's scenario actually play out. Now look, for me, it's very simple. I look at this and I say, okay, there's two scenarios here. Number one, that Tom Lee is right. What does it mean? Well, it means that great companies that are getting better and better and better over the past few quarters are now getting cheaper and cheaper and cheaper because of panic. For me, this is a buying opportunity. I understand that if a company gets better, but the price drops because of sentiment and panic short term, it's an opportunity for me to load up. It's the same thing I've been doing with Tesla and Palantir the past few years. Ain't nothing changed. I know what I am. I'm a long-term investor. I am not a trader. If you are a trader, there's a whole different game that you should be playing in. I'm running the marathon. You're running the sprint. We're not compatible. We're in completely different ball games. The problem is that a lot of newer investors simply don't understand that simple concept. And they have this mindset that's geared towards trading, and they're trying to be a long-term investor with that fallacy of a mindset. It's never going to work. You have to understand, I'm a long-term distance. I'm a runner that needs to run 40K. I'm not going to be running as if I'm running the 100-meter dash. It's simply not going to work. Now, look, I can't predict what's going to happen in this market. Nobody knows. Now, we've seen the stats, right? In the first half of this year, the market has gone up by more than 10%, which means that statistically, the second half should be also another 10+%. We know that it should be statistically, historically, a great second half of the year. We also know that September and August are the worst months of the entire second half. We also know that November and December are the best months of the year in this scenario, giving us 2.2 and 3% average statistically, historically. However, nobody can predict how a specific case, a specific year plays out. Statistics, prior things, history, they don't guarantee nothing. Look at what happened in August. August should have been a negative 0.6% according to the same stats and history, but it was a positive month. So all I'm saying here, you cannot build a predictive tool that's going to give you certain results into the short-term behavior of the market. It's impossible. So Tom Lee might be right. He may be wrong. I don't know. I cannot predict it. So I got to be prepared for both options. I have to prepare, and you as well, for two scenarios. Scenario number one, in which Tom Lee is right. Scenario number two, Tom Lee is wrong. So what happens? If Tom Lee is wrong and the market keeps pushing up, I slowly dollar cost average, meaning I keep buying slowly the stocks I love. If Tom Lee is right and the market dips, I understand now it's an opportunity for me to load up and add more and more at a discount to the stocks I love. It's very, very simple. And I want to warn you guys, some people will take this video and the comments by Tom Lee and they're going to say, I'm going to sell now before the worst happens and I'm going to buy back in November 1st, just in time for the big spike. Statistically, historically, Tom, you told us. No, that is not what I'm telling you. That's going to be a very unrewarding exercise. Nobody knows that's gambling. Because look, you might miss some really, really great days in those horrible times. Some of the best days in the stock market came during a period of red. You never know when the best days are going to come, and selling out to try and time the market is never going to work long-term consistently. It's impossible. Look, if you miss the best 10 days over the course of the past 20 years, your entire return is slashed by 50%. Don't gamble, don't sell out, and try to time the market. It's not going to work. That's not what Tom Lee is advocating for. That's not what I'm advocating for. We're talking about dollar cost averaging and using panic to buy, using emotions to buy. It's very, very simple. Most investors in this market, most retail investors, have a lot of recency bias. So if they see the market drop 10%, they're going to freak out. Emotions are very powerful. When you see emotionally your portfolio up by 10%, that's half as scary as seeing your portfolio drop by 10%. A 10% drop is twice as painful as a 10% gain. So when people see that, they're going to freak out, they're going to panic, and they're not going to have their emotions in check. This community and my viewers, I hope, now understand how to prep for this mentally, psychologically, financially, getting the money on the sideline, getting your mindset in the right place, and getting ready for whatever happens. You have to accept the fact that drawdowns in your portfolio are absolutely freaking normal. They're going to happen. And if Tom Lee is right, there's going to be a lot of opportunities in this market. There's a lot of beaten down stocks that might drop even further. Obviously, the entire small caps, it's going to be a bloodbath. The IWM, you have ASML, Tesla, CrowdStrike, a lot of companies at a very comfortable position right now, and they will be impacted by this market if it drops. So you're going to have a lot of things lying on the ground at very, very cheap prices. If you pick good companies and invest for the long term and just keep steady and buy all the time, you're never going to lose money. It's as simple as that. Now look, there's always going to be reasons to sell. I'm going to show you right here some headlines, and I'm going to give you the dates just to kind of show my point. Check this out, right? Global recession in 2023 is inevitable. That was in The Economist. CNBC, this is a bear market rally. This was in April 2020 before the spike of post-COVID, right? 2018 Forbes, why markets are still heading for a crash. Still waiting for that crash, by the way. 2015 CNBC, stocks and bonds will crash soon. 160% since that article. Guys, there's always going to be reasons to sell. And just making fun of these headlines doesn't mean that Tom Lee is wrong. In fact, I think he might be right. But here's the thing. This is my strategy going forward. I wanted to keep this to the end of the video to reward those who stayed all the way through. Thank you. Here's your reward. My strategy is very simple for the next 8 weeks that Tom Lee just defined. And here it is, right? I have Palantir and Tesla. You may have other stocks, right? I have the S&P 500, Palantir, and Tesla. What I have is a threshold amount for every single stock, which means that I have a specific price at which I'm going to start to double down. And if that price doesn't hit, if the stock doesn't drop to my threshold amount, I'm going to keep buying at the same price. But if the stock drops below my threshold amount, I'm going to start buying at a double pace, at $200 a month versus $100 in normal times. And I'm going to keep doing that until the price climbs back up above the threshold amount. And in fact, this whole system is something I broke down A to Z, full tutorial in my last Academy session for about 45 minutes. It's available right now for every Academy member. If you are an Academy member, go watch it right now. I've explained how to set your threshold amount, how to calculate it, and how to manage yourself in these kind of situations. It's all in the Academy. And I know the Academy was closed in August since I was on vacation. We have reopened 5 more spots until the end of September. Once these 5 spots gone, new spots will only open up in the beginning of October. If you want to grab one of these spots, welcome aboard. I'll see you next one. Peace. So Tom Lee